Hi folks, Ryan Honeyman here from Lift Economy. Many folks have come to us over the last 10 years and asked, how do I get more involved in creating an economy that works for the benefit of all life? They also ask, what skills and experiences do I need to help make this transition? So 3 years ago, we created something called the Next Economy MBA to help address this and similar questions. Lift Economy's Next Economy MBA is an online course that's designed for entrepreneurs, aspiring entrepreneurs, students, recent graduates, employees, and folks who want to learn more about transformational next economy strategies and businesses. Join the growing alumni network of nearly 250 alumni who've gone through this program and learned essential skills and hopefully built lifelong relationships for catalyzing businesses in the emergent and regenerative economy. So we encourage you to check out our course. You can go to lifteconomy.com/MBA. The next course, Cohort 7, starts on September 21st, 2021. So once again, go to www.lifteconomy.com/MBA. And now, on with the show. Welcome to Next Economy Now. The goal of this podcast series is to highlight the leaders who are taking a regenerative, bioregional, equitable, democratic, racially just, and whole systems approach to creating the new economy.
I'm here with Marco Vangelisti. Marco is a good friend of Lift Economy and one of our local heroes. We've learned a tremendous amount from Marco, and I'm really excited to be able to share with everyone today by speaking with Marco about some topics that he's helped us with, and I think he has a lot of gift and service to bring to the world around. Marco has been instrumental here in Northern California in helping organize the slow money investing movement and chapter and group here. As well as he's started a curriculum called Essential Knowledge for Transition that we think is, true to its name, essential for individuals, communities, enterprises, anybody who is hopeful to be working towards solutions to some of the most intractable or large problems in the world, everything from climate change to species extinction to gross income inequities and other structural problems that are really frustrating. Marco's information that he has to share of understanding things like the finance system, currency, is extraordinary. That literacy is helpful to make choices that all of us can make in our day-to-day lives that actually make a difference towards changing the larger circumstance. So I'm excited to talk about some of those things. But I'm wondering, Marco, if you could kind of introduce yourself and maybe share a little bit about your background.
Sure. Kevin, thank you for the invitation. I'm thrilled to be here on this podcast. I spent 20 years in finance, and I usually say I am a environmentalist. I'm passionate about social justice, and I spent 20 years in finance. So I have to talk about cognitive dissonance. Because to a certain extent, that was the moment that I realized I was on in the right place. Was the time in 2009. I was working for a really good investment management firm. Was managed very professionally, very ethically. Very smart colleagues, great clients. And in fact, most of our clients were endowments and foundations, including a couple of environmental foundations that just about everybody knows. And we were doing great. So our clients were really happy with us. We were the best performing emerging markets equity fund with a 10-year track record. And I remember that year kind of taking a closer look at some of the best performing stocks. And one of them was a palm oil company based in Malaysia that had destroyed, tens of thousands of acres of rainforest, which is the habitat of the orangutan. And I found it a little bit strange that here I am, an environmentalist, helping grow the assets of an environmental foundation that was doing actually good work trying to save the orangutan habitat. And yet the investments themselves were destroying the very habitat that the foundation was created to protect. It's one of those moments where you understand everybody's doing their best.
Mm-hmm.
The chief investment officer of the foundation that picked us did a great job. We delivered great returns. We did our job very well, right, growing the assets of the foundation. But if you step back and you're saying, what are we really doing here? This whole system is set up in a way that we're using funds set aside to do good, and they end up actually destroying the very things that that foundation was trying to protect. And so that was the moment kind of when I had to step away, and I started thinking about these large systems. And as you said, I ended up developing this curriculum. I usually deliver that in 3 talks, and all of those are available on YouTube and my website, to understand how the money and banking system works, the economic system, and the financial system. These are almost operating systems of society, and it makes it very hard for us to bring about the world we want. And so the idea is to understand the design of those systems, understand the intervention points, and start thinking about how we would design a system, whether that is money and banking or economics or finance, that is in line with our values and our desires for a better world.
Wonderful. Yeah, those critical inflection points, those moments of epiphany, are important. I really appreciate your story and the courage that it takes to then go into the discovery and the transition. Because as you learn about these things, as I learned about some of these things, it's a little bit scary and maybe frustrating is a better word. Especially, for example, Lift Economy has identified when we started the currency and the creation of money and the way it's done in today's society as being especially problematic. I guess the way it's done and the consequences of how it's designed in this, like you well put, like an operating system or the DNA of the economy. And these consequences that when they are extrapolated out to the way the business as usual economy metabolizes the consequences of how money is created, largely contributes to some of the artifacts we see, that the way business exploits nature or exploits human relationships, as not because people are evil, but just because that's almost the mandates to capital. I'm wondering if you could share I know you have talks about this in the curriculum, and it's a bit unfair for me to ask, but if you could maybe summarize in brief, to the best of your ability, what about the way money is created do you see as being problematic? I know there's a lot to say about it, but
well,
if you can
here's the interesting thing, that if you look at a textbook, an economics textbook, it will say that banks are financial intermediaries that basically collect savings from people that have more money than they want to spend right now in consumption. And they then lend that money to entrepreneurs, and therefore help with the capital allocation in the economy to grow it, right? Mm-hmm. So that's basically the story that is told in most economics textbook. It turns out that it is faulty on 2 grounds. The first one is, and this is the most kind of profound feature of our money and banking system, is that banks actually create the money they lend. They don't have to wait for people to deposit the money in their bank. What they can do is they can monetize the promise of the borrower to repay. It is really a swap of IOU, which is the beauty, if you want, of banking and of money, is that you go to a bank and you take out, let's say, a $500,000 loan to build a business. your promise to repay is an asset of the bank, and the bank creates a liability, which is basically $500,000 in your checking account,
right.
which is just an accounting entry that nevertheless creates purchasing power for you to do what you need to do, pay your employees and build your business and so on. This very process, of money creation through the process of lending by banks has both positive and negative features. The positive feature is that it introduces elasticity in the money supply. So, if there is a lot of economic activity, banks will be doing a lot of this money creation in the sense of a lot of lending, and therefore a lot of purchasing power being injected in the economy. And the problem with that is that the allocation of this credit and the overall amount that is being created, it's not really driven by the needs of the economy as a whole. It's really driven by the assessment of the profitability of doing so by the banks. And that tends to be a little bit too optimistic in the good times and a little bit too pessimistic in the down times. In other words, the very process of money creation by banks when they lend is at the core of the business cycle. The other, I mentioned that the story of the textbook is wrong on two accounts. The first one is this, which is, I just explained, which is banks are not financial intermediaries. They actually create the purchasing power and the money that they lend out through really an accounting entry.
Right.
But the second part of the story in the textbook is that they actually fund the capital expansion of the economy, that the lending they do is really lending towards productive activities that create new goods and services. So if you look at the textbook, it's always banks lending to entrepreneurs building the next factory or business. In reality now, most of the lending of banks is for real estate. More than 50% now of all the credit created by banks worldwide is for real estate. Now, what is the problem with that? The problem with that is that most of the time that lending does not go towards construction of new homes, but just towards the competition among ourselves for a limited amount of housing in desirable locations. And this creates real estate bubbles. There is also a lot of lending going into financial speculation.
Yeah.
And, just to give you an example, I worked briefly for an impact fund, and one of their potential clients was a company called Oryx. And Oryx is a financial company in Japan, and they raised about $20 billion by doing a stock offering. So they have $20 billion in equity. And then they went to a Japanese bank and said, would you lend us $80 billion, given the fact that, could you leverage us 5-1? And the bank said, sure. So in that particular moment, the bank created $80 billion of brand new money. And then this finance company was going to invest around the country, including this impact fund that I was consulting with. And so this is another example of money creation now, especially when lending occurs towards real estate purchases or towards financial speculation, is causing bubbles, both in real estate, in financial markets, and creates a lot of instability. And so I guess the bottom line here is that you're asking me what could we do in terms of addressing the design problem of banking as it is set up right now, where again it's the expectations and profit motives of banks that determines the amount of credit out there and the amount of money in circulation in the economy, and not the needs of the economy per se. And obviously, what we need to do eventually is both control the overall amount of credit created by banks. Right now, even though some people think that the Fed is involved in doing that, the Fed is actually not controlling the overall amount. It's just controlling the cost of the money that banks use to pay themselves, which is the federal fund deposits. And we more importantly, we need to control where that credit goes and it's created. Because if it goes towards the productive economy, then it's not a problem that some money is being created in the process, because more goods and services will be generated by the economic activity if it is directed in the right way. But if it is directed towards the purchases of existing assets, whether those are stocks and bonds already trading out there or houses that have already been built, then this creates bubbles
and inherent instability. So in kind of some aspects of summary would be, it's not just something as simple as saying a fiat currency without material backing, and it's not just saying fractionalized lending. It's in some ways it includes those things, but it's deeper than those things per se. Another question I would have on that for the literacy about this and why it's so important moving into the next economy. I'm curious your take on this idea of the profitability expectations of the banks. What market rate returns mean for a bank, what a bank needs. Who determines that, and why is that potentially problematic? And the follow-on question to that is this idea: if banks were lending out to sectors of the economy that were indeed enhancing or stimulating productivity, real productivity, and not speculation, is there still potentially something problematic about the notion of interest or this profitability expectation of the banks? And just a brief comment, because I know, again, you have a great curriculum on this, and there's a lot to say about it.
First of all, a general comment. Some people say, we should go back to the gold standard, and that would fix the money system. Now, the idea of the gold standard is that there is some physical restraint as to the overall amount of money in circulation, because the money needs to be backed by gold. And so, it's going to be constrained by that. It turns out that even when we had the gold standard, banks could create credit on top of it. In fact, That's the very reason why we had bank runs during the gold standard, because all the money and credit the banks created, they created with the assumption that if somebody really wanted to, that could be converted into gold. But you couldn't really do that, because there wouldn't be enough gold for that, because the banks were creating, there's a construct of credit on top of whatever monetary base you use, whether that is fiat currency, issued by the central bank, or whether that is gold deposits. The banking, the way it works is by creating and expanding the monetary base through credit creation and credit extension. Now, you're referring to another point, which is most of the money we use now, because most of the money is created by the banks, it's created as debt, and there is an interest associated with the debt. Now, it turns out that it wouldn't be so much of a problem if no one within the economy ever saved anything. You can actually build an economic model where all the money is lent into existence at an interest, and then at the end of all the circulation around the economy, everybody gets paid back, including the bank who created the money in the first place, and nobody is in debt.
Right.
But that requires that no agent within the economy ever saves anything. As soon as you have some people saving, and of course we have a lot of people saving, especially, rich people do not spend all the money that they have. They invest a lot of that. Then you create basically the problem of unrepayable debt that can only be financed by additional borrowing. And so another, corollary to that is, if you want to fundamentally fix the money system, I think at this point we need to combine the control of the overall amount of credit created by the banks and where that credit is allocated with a certain amount of debt-free money creation by the U.S. Treasury directly. This is what is called the overt money financing or the fiat money creation by governments. And it's kind of a taboo topic, but it's being considered now because we are realizing that we're entering a stage of insufficient global demand worldwide. There's a combination of the slowing down of the ability to gather resources, the aging of the populations, the deflationary effect of very large amount of debt, and so on and so forth. What we might be doing in the next couple of years, I suspect, is to do overt money financing of government deficits to a certain extent. And this would help with the issue of the debt overhead.
Great. The observation there that really resonates is that it's the taboo topics, or traditionally taboo topics, that where to really fundamentally transform an economy to work for the benefit of all life, that need to be brought to the fore and to the table. And I really appreciate your curriculum and the work that brings literacy to that. I'm wondering, in addition to your curriculum, which is wonderful and accessible, like you said, through YouTube and through your website, I'm wondering if you could just mention on this currency topic, and then we could pivot to talk about something else, to the investment piece. I'm wondering if you could mention one or two other resources that you really value as being thoughtful and considerate on either the problem statement or, more importantly, maybe what the solution might be, these taboo solutions that we need a more general literacy around.
Well, there are three books that I really like. One is the book called Modernizing Money, put out by the Positive Money Institute in the UK. Their position is pretty radical in the sense that they are lobbying for the removal of the ability of banks to create money in the first place. In other words, to turn them into what people think the banks are, intermediaries waiting to get deposits in order to lend them out. This is also called the Chicago Plan, that was proposed here in the United States by Irwin Fisher and by early Milton Friedman, and even by Henry C. Simons, who's the founder of the conservative Chicago School of Economics, to basically do 100% reserve banking. So do not allow banks to create money, and they would basically have, for every dollar that they lend, they would need to have central bank deposits backing them. That is a little bit of a radical solution, although I can be very sympathetic to that. But the good news is that the book Modernizing Money is really a very clear, accessible way to understand how the money and banking system works. Another book that I really like and just came out now, it's published in 2016 by Adair Turner, and it's called Between the Debt and the Devil. And the devil being fiat money creation by governments to monetize, to basically pay for their fiscal deficit. And it's really a breakthrough book, in my view, both in the clarity of exposition and in the courage to just break those old taboos and come up with ideas. Adair Turner, by the way, used to be the chairman of the Financial Stability Authority in England, and he was put in charge of that 5 days after the collapse of the Lehman Brothers. And so basically he says it's like being put in charge of the Titanic after it hits the iceberg, but before it sinks. So this guy has a lot of credibility, and that book is really fantastic. The other one, for people that are interested in local currency and how to design them in a way that would work and it's sustainable, I really like the book The End of Money of the Future and the Future of Civilization by Tom Greco. Although I don't agree with his understanding of the currency and banking, I still think that it's a very interesting book, especially for people that want to put together a local currency and do it in a way that is sustainable. Because I see a lot of 30-year-olds, male usually, coming up with these currencies, and 2 years later you check up on them and the currency is no longer working. And the reason is usually it's poorly designed. People don't understand how to circulate that, how the cost of managing the currency itself. Anyhow, but those are three good resources that I would suggest.
Wonderful. Really appreciated. Quick question on that last, just in a short, I'm looking for maybe a short summary. Do you see local or complementary currencies, some polyculture of currencies, as being part of, what could be a designed solution to some of the problematic nature of the operating system of the current economy?
Oh, absolutely. So I focused on the dollar system because
Right.
we cannot ignore it, and because all the debts we have are denominated in the dollar, and we cannot discharge them with local currency. But at the end of the day, there is interesting research in the last 4 or 5 years about the resilience of systems, complex systems. And it turns out that the resilience of a system depends on the balance between efficiency and diversity. And so a very diverse system is not super efficient, but it's resilient. And if you have a very efficient system, it could actually break down. So having one national currency and one only could make the whole system collapse, as we got very close to in 2007, 2008. And so the idea of having a diversity of currencies out there that addresses different niches and different needs and different purposes, I think is very important. And I'm in support of that.
Wonderful. Great. I appreciate that insight. So I'd love to know more about and have you share a little bit about some of as people become aware, sometimes of just the global problems themselves. Again, climate change, species extinction, gross income inequities, social inequity, structural racism, all the really big problems. And then they start linking those problems to the operating systems, the DNA of the economy at large, the business as usual economy. Sometimes what happens is people become a little bit frightened because they find themselves embedded in or somehow naively complicit in the perpetuation of those systems through how they invest and where their savings spends the night. And there's a bit of anxiety about and angst about what can I do? How can I find a way out of this? What can I do with my money, with my resources? I still want some sense of security in my life for my family and my community, but what can I do? What options do I have? And there's a bit of a paralysis and a lot of uncertainty. I've Lyft Economy and myself have been very impressed with your work, and part of your curriculum is helping people navigate through that question, what can I do? And I'm wondering if you could maybe share a little bit as maybe a teaser of your forthcoming workshops. What are the broad strokes of what some of these options are? And I'd appreciate if you, after that, go into at least one or two stories. One that I'd really love to make sure is shared with the listeners here is one of my favorite organizations in the entire country is the multi-stakeholder cooperative in Sherwood, Oregon, the Our Table Cooperative, which I believe you're an investor in. And maybe if you could share a bit about that story as an example of why where these possibilities exist and why they're important.
Right. Well, the first thing I would like to say is that be easy on yourself, in the sense that we are all part of a system, and it's very hard to not be participating in it. I mean, it's really hard. I mean, we can make choices, right? And we know which choices we can make. So, for example, my choice was to walk away from a well-paid job. I mean, I could do that because thanks to that job, I had some savings that could, carry me through. But of course, I wouldn't go to a single mom in Richmond and say, "You're working for Chevron, leave that job." No, if that's the job that she has to feed her kids, there are certain things that I can do, but I cannot ask other people to do the same. So we first have to recognize that we're all complicit in the system. We're doing the best we can. And it's important to confront the fear and recognize it, both the fear of being complicit in the system and the problems that we're going to face, and also the fear of take the next step and move in the right direction. Really, what I share with people, and this is kind of my realization after being an insider in finance, is that most of the investments we make today, okay, are not happening in a distant planet where only the financial returns are repatriated to us. The investments we make today are affecting the world we live in today. And if you trace it back, you can see that a lot of the problems with global warming and species extinction and loss of habitat is related to very large multinational corporations that have to pursue the maximization of profit at all costs. And they're going to find, the place where the labor is cheaper, where the environmental restrictions are not there, where they can bribe the government to do things that could damage maybe the society or the ecosystem. I mean, that's almost inevitable that would happen. And so I would say, just recognizing that and sitting with it for a while, it's hard, but it's an important first step. And then my perspective is that, we talk about diversification as being very important. If you go to a financial advisor, they will say, you need to have a well-diversified portfolio where you're investing in the United States, in Europe, in Canada, around the world, in emerging markets, and you need to have both bonds, and you need to have stocks and so on. And if you put together a very diversified portfolio, then, you're going to be fine down the line, and you're going to, earn some decent returns for your retirement. So there are two things to say about that. One is maybe investing, as we have been doing so far, may return some financial returns to you, but it might leave you with a planet that is not habitable. So, you have to look at that dimension too. And the other one is most of the business, in fact, 99% of the businesses in the United States are not publicly traded. These are small businesses. They actually are creating more than 65% of the jobs in this country. And they represent more than 50% or roughly 50% of the GDP. And yet we are not invested in them. We're invested in the large multinational corporations that have stocks trading on the various exchanges, and they're part of the mutual funds. So we're actually missing half of the economy in our diversified portfolio, if you want. Not only that, when we're saying, we're investing in the United States, now we have to invest in Europe and so on. The question is a geographical area like the United States really the smallest and most refined way of looking at geography? I mean, if I think about my life, I spent 90% in Northern California. I eat probably 50% of the food I eat is from Northern California. About 80% of my expenditures and shopping is here in Northern California. And how much do I have invested in Northern California? And a lot of people could probably say, oops, probably almost nothing. In the Bay Area, okay, there are the Googles and the Facebook and so on. I don't count them as really local companies, although they're providing a lot of local employment. But you get my drift, right? Yes. So in terms of both what's happening out there in the world and the ultimate impact of our investments, and also in terms of diversification, it makes sense to have some of the money invested locally. And then the question is, how do we do that, right? Because when you do local investing, you have to spend some time thinking about it. It's not like you give the money to a portfolio manager or a financial advisor, or even really, let's face it, if you bought some stocks on the stock market like Apple and Google, you didn't read any prospectuses. You just bought it because you knew, okay, if I really get tired, I can just sell it, and there is no consequence, or I can always get out of it or something. So local investing is a little bit tricky, obviously, because some of the small businesses are not going to succeed, and so an investment in a local economic entity carries its risk. But I'm balancing that with the risk of continuing investing as we have done. Right. And if you balance those two, you realize, we should have maybe 1 or 2 or 3% of our portfolio invested locally. And then the question is, okay, who can invest, right? And
Right.
so there are now, as you know, when an entrepreneur is raising funds for his or her business, they're basically offering a security.
Mm-hmm.
And the SEC was created to really protect investors. And so the SEC says if you're offering a security, you need to register with us and with any state where you're offering your security. That's called the IPO,
Mm-hmm.
right? And Google and Facebook went through that. It's very expensive, extremely involved process. And so the SEC at a certain point said, okay, maybe if you're just offering this to rich people, we don't need to be so overbearing and have you go through all these hoops. You just deal directly with them. We don't feel we need to protect them because they're rich enough and probably they know what they're doing. And so we have now two classes of investors: the accredited investors, people that have at least $1 million or a high income, that are not that scrutinized or protected by the SEC, and entrepreneurs can reach out to them for private deals,
Mm-hmm.
right? So where they don't tell the world what they're doing, but they just connect with this rich people that can invest in them. And the non-accredited investors are basically the rest of us. And our choices are either buy mutual funds or buy the stocks of the large companies that have traded. Otherwise, it's kind of limited what we can do.
Yeah.
But the good news is that the SEC has given some exemptions that allowed people to register their security in their state, like these are the direct public offering, for example, and then those can be shared with everybody. And again, we will be using as examples of how you look at local investing, how do you assess the risk of a local investment. We're going to be using the direct public offering that are available to the California investors.
Yeah.
And so the plan is to help people understand the big picture, why there are both financial and non-financial risks involved in leaving the money where it is, zooming around the world, doing who knows what, mm-hmm. and looking at the fact that actually investing locally can be diversified, can basically build both financial and non-financial benefits for ourselves and our portfolio. And then looking at how do we do that? How do we look at individual deals? What is relevant? What is not relevant? How do we assess, how risky an investment is, and so on, and how it is aligned with our values and the things we care about. So I want to talk about a couple of specific investments so that I give people an idea. And one thing we need to keep in mind, almost like stepping back, the reason why we invest is to fund our future consumption.
Right.
Mostly, right? So at a certain point, you're going to take that money and you're going to turn it into, a vacation, a car, some food, right? Every time we spend money, you can think of it as a minus 100% return from a financial standpoint.
Right.
And we're willing to do that because we like the non-financial benefits, right? I mean, I go to the opera, let's say I spend $100 to go there. That's a minus 100% return on that $100. But the benefit is I enjoyed the music, I was part of the community, and so on and so forth. And so with local investing, it's a little bit like that we need to factor in the non-financial benefits that we get out of it. And so I'll give you an example. Soul Food Farm is the first loan that we did as a slow money network here about 5-6 years ago. And it's a poultry operation in Petaluma that treats the animal very well. At the time, was one of the 2 poultry operations that received the animal welfare certification. And, pasture chickens, really happy and so on. We went out there, we fell in love with the farmer and with the chickens. We wrote the check and did a loan. And the idea was they wanted to put irrigation in their pastures so that they could extend the period over which their chickens could forage and eat the grass. And then a number of things happened. One is, an explosion in San Bruno because of a PG&E pipe caused PG&E to preemptively rent all trench diggers in a radius of 100 miles. So now all of a sudden they couldn't find a piece of equipment to actually dig the ditches and put the pipes down. And then, something else happened, and there was a drought in the United States. The price of feed for the chicken spiked. Long story short, after a couple of years, the business discontinued operation.
Mm-hmm.
But we had a relationship with the farmer, and the farmer said, I am still intending to pay you guys. It's just that right now I need to restructure things. I cannot pay you at this point. And we basically said, yeah, we understand. We know also the risk of doing investments of this type. And so she ended up restructuring the business. She moved away from the poultry operation. She now has more oil and herbs and fragrances and so on. Well, to make a long story short, a couple months ago, she paid off this loan.
Huh.
So after a turnaround, and I think that highlights two things. And to me, the known financial return of that investment, which returned maybe 1 or 2%, at the end of the day, it was a very low interest loan that we made, is the fact that I know that this operation is still out there now because of our patient capital and our flexibility. I've been eating a lot of their chicken and their eggs, and I just love the fact that we are part of supporting our food shed, and that diversity, in terms of small operations and farms, is important to us, and we helped keep that in place.
So
the other one is
just highlighting the non-financial benefits of local self-reliance, community benefits, and then the human relationships, the business as usual financing vehicles and structures would, because not being concessionary or patient, would never have allowed that to happen. If market rate returns were demanded of that farmer during the circumstance of drought and irrigation, mainline diggers not being available, too bad. There might have been some liquidation and recovery. But
right, they would probably sold the farm, and then we would have lost the farm, and that would have gone, who knows, maybe instead of being organically farmed, it could have been, become part
housing
of
or whatever.
Commodity agriculture,
Yeah. Yeah. So it's there's these, when you say non-financial returns, it's not only the personal returns of human relations with a farmer that's ethically providing delicious, nutrition in the eggs and the so forth, and now maybe medicine and oil, but it's also benefits to the overall community. The community
Right.
is more beautiful, is more locally self-reliant to have the farmland still be farmland and still not being subjected to industrial herbicides or pesticides or whatever. So.
Well, the other thing is, there are this kind of mythical market rate of return, which at this point, it's like, really, last year the S&P, I think, lost 1% or no, went up 1%, and this year so far is down 8%. I mean, it's like, it's not a God-given right of capital to grow by 5, 6, 7, 8% a year. And in fact, given the situation we're now in with this overvalued asset classes, we'll talk about that in the workshop. It's like stocks and bonds right now are so expensive because of the massive liquidity operations of the Federal Reserve in the last 4 or 5 years to try to get us out of the hell house of 2007, 2008. Is everything is really expensive, and if people think they're going to get 7, 8% out of their stock market investments or bonds, I think they're wrong. I think they will be sorely disappointed. And there is the other argument to be made, which is when we know enough in the Bay Area now to buy organic food, and we're not going to say we're going to pay the least amount possible for these calories, which would mean you go to Walmart or some other large outlet to get food that is industrially produced, right?
Mm-hmm.
We know that we're willing to pay $6, $7 for a dozen of eggs because of the pastured egg, and of course we can get them for $2 at Safeway, but we're willing to pay more. We can think of local investing in the same way. the price we're going to pay for, or if you want, the interest we're going to get from a loan is going to be a little bit lower because there's an organic loan. You see what I mean? It's like there are other things beyond just the price or the interest that is important in order to support your local community and your local economic vitality.
It's valuing those other forms of capital and all the qualitative and intrinsic values. So expanding the notion of value is critical. I really appreciate that perspective. And okay, and maybe if you would, I'd love it if you'd be willing to share maybe one other story as an example.
Our Taboo Cooperative, I can tell you that. So our Taboo Cooperative is this wonderful project by Narendra Varma. He used to be a Microsoft engineer, and he left, and at a certain point recognized what was going on in the world with the large systems and so on, and decided to do something radical, which is to buy a piece of land and see if he could model a systemic way of, a systemic alternative to our market system and to capitalism, really. Mm-hmm. And the idea was that he created the land, he put it into a land trust, a nonprofit that owns that. He created basically a multi-stakeholder cooperative where the workers are member owners of the cooperative. There's also a shop on the farm that sells the produce of the farm itself and of other producers of organic food in Oregon. And so the producers are also member of this multi-stakeholder cooperative, and the people buying food from the cooperative are also members. So in other words, it's really an operation that is owned by and directed by the farm workers that are working on the farm, the producer that are selling produce through the farm shop, and the consumers that are buying. And so through that, I think it's an example of a non-capitalist organization of economic activity where everybody is involved and participating both in owning, sharing the economic benefits and the decision making within the operation, within the co-op. And I'm an investor. They're also looking for funding to get over the hump this year to fund their operations. And unfortunately, that is open at this point only to accredited investors. So I don't know if that would change. Although people can certainly become members of the cooperative if they want to support the idea. And so that's another way of participating in the success of this.
And so these models, which are really courageous, so grateful to Narendra and you and the other investor class to engender this possibility. These models, and there's a few of them out there that Lift Economy is aware of and associated with, to us are really essential to try on, develop, become successful, and then open source so that they can be replicated and regionally adapted. If we're ever going to voluntarily find a pathway to a more equitable share of income and assets in the affluent world economy or the global economy in general, we need these alternative economic commerce and exchange models to be thriving. And this idea that the local cooperative consumer member is incentivized to transact with the producer members, essentially because they can play a role of governance or ownership through their participation. And there's what I'm excited about is it's not just our table. There's a few of these models, more than a handful, and more that are being developed and tried on, where the incentives are structured as such where the voluntary or ethical decision not to, say, make purchasing decisions from the exploitation economy or the business as usual economy can be driven by self-interest, which it will encapsulate all those qualitative benefits, those cascading benefits that occur for the community and the environment, and will result in more equitable distribution of assets and wealth. So I'm super grateful for you pioneering and helping with that model. And I'm glad that you're going to be sharing about that at your workshop, so that people know that these things exist, and they're out there and that they are developing. Marco, I've taken up a bunch of your time here this evening. I'm wondering if there's any other things you want to say about the forthcoming workshops, or some of the resources that you've produced through the curriculum, or any other ways. I guess the specific question I have for you is, how can we help anybody who's listening to this? What can we do to help you share this essential information that you've put together in such a beautiful way? This is very important for all of humanity, really. So what can we do to help?
Well, if people are interested in learning more about the large systems and my talks, they can go to my website, which is ek4t.com. 4 is the number 4, and find it there. For the workshop, this is meant to explain to people that global finance is an opaque landscape. That if we really look at closely, we find that our investments are tied in activities that we don't like. And, people may be longing to operate it with integrity in all parts of their life, but feel under-equipped and bewildered by the idea of aligning their investments with their values. And so if that's the case, there's a chance to learn how to tackle that, how to learn basic portfolio management techniques. I used to teach portfolio management to really chartered financial analysts for about 12 years. So how do we look at it and understand the language that our financial advisors are using? How do we look at clarifying our personal values and how to connect them with the investments? And then how do we learn what is the safe portion of the prudent allocation within our portfolio for local investing, and how do we do local investing, with some examples and opportunities out there to take a look at. So that's basically the idea, is because every time I talk about the financial system, people come to me and say, would you manage my money? And I say, no, I can't really do that, because as a fiduciary, I would have to be restricted to the idea of maximizing returns at all costs. And it's really a question for people to think, okay, I don't have to buy the cheapest eggs. I can buy organic eggs and pay a little bit more. The same thing is with investing. I can set aside a little bit of money, invest in my local economy, and benefit now from some of the benefits that I would be obtaining down the line when I spend my money from my investment portfolio. I can use my investments right now to create the world I want to live in. And there's a way for people to kind of broaden their opportunity to meet and connect with like-minded individuals on a similar quest, and do that in a safe space.
I love it. Really important information. I don't know. There's some good books out there that I think we both know of, but I don't think there's anything like this where you can answer questions. It's unique, or at the very least very rare, what you're offering. So I'm grateful that you're out there, and I know Lift Economy will be sharing this information with as many people as possible. And we also, and I love that you're being very pragmatic and considerate in terms of the approach of leveraging what is just sound financial advice and guidance to allocate certain portions. I can easily imagine, as our local economies become more resilient and maybe even relocalized, however far in the future we want to prognosticate out, where that small allocation of our kind of portfolio can actually grow and maybe become a larger, substantial portion of our investing. I can easily imagine how, and actually maybe that's an essential piece, but let's not get ahead of ourselves first. Let's do first things first. Marco, any last words to share before we sign off here?
No, thank you for the opportunity, and it's been fun. It's always great to follow your work and know that you're part of the tribe of the people trying to bring about a better world. So thank you for that.
Thank you, Marco.
Next Economy Now is a production of Lift Economy. To listen to all of our episodes, go to lifteconomy.com/podcast. That's LIFT economy.com/podcast. You can also sign up for our monthly newsletter at lifteconomy.com/newsletter. Please also rate and review our podcast on iTunes, Spotify, Stitcher, or wherever you get your podcasts. Thanks for listening.